class, and welcome to our introduction and refresher to journal entries and double entry accounting in BACC 531 Managerial Accounting. Hope that this lecture finds each of you doing well and having a good day at the time that you're watching this. This particular mini lecture will serve as, again, an introduction and a refresher to the foundational points of double entry accounting and how to do journal entries, how to understand journal entries and the basics of journal entry format and how we go about the process of recording and posting journal entries. So as we go through the balance of this mini lecture, we'll be taking a look at a few different things. First is the accounting equation and the foundation of double entry accounting. Secondly, we'll look at double entry accounting basics, specifically with regard to T accounts, debits and credits, and the rules of debit and credit. And then finally, as the third point, we'll look at a couple of example journal entries and the typical journal entry format that you'll find. Now, I do want to take a moment as we examine these topics to say that in the context of managerial accounting, I'm not so much concerned with foundational journal entries. I do ask, as you go through the balance of the course, you'll be asked to perform certain journal entries, but that is with the intention of helping you understand the relationships between different accounts and how those accounts function in terms of the accounting system. So my concern is more that you understand concepts rather than the more specific elements of journal entering and or journalizing and dealing with double entry accounting. So without further ado, we'll take a look first at the accounting equation. The accounting equation serves as the foundation for what we do in double entry accounting, and the accounting equation is expressed as assets equals liabilities plus owner's equity. These three elements, assets, liabilities, and owner's equity, form the foundation of the double entry accounting system and the foundation of what we do in the context of accounting, whether it's financial accounting or managerial accounting. All accounting systems come back to this fundamental equation that forms the framework for accounting information systems. I would also add here that double entry accounting has a very long history to it. As a matter of fact, the father of double entry accounting was an Italian monk and mathematician named Fra Luca Pacioli. Fra Luca Pacioli in 1494 published a mathematics textbook called Summa de Arithmetica Geometria Proportionae Proportionalita. You do not need to know that for a quiz, but it is an interesting trivia fact in the world of accounting. And that particular mathematics textbook, while it wasn't focused on accounting per se, it actually laid out the framework for the double entry accounting system that we know and use today. So the origins of a formal double entry accounting system go back to as early as 1494. If you're familiar with history, particularly the history of the Americas, you'll know that in 1492, as the elementary school saying goes, in 1492 Columbus sailed the ocean blue. 2 years later, in 1494, Fra Luca Pacioli founded the system of double entry accounting that we know and use today. So this has a very long history to it. It has been developed considerably over the years and has become more and more sophisticated, but again, the origins go back quite some time. In terms of these elements that compose the modern framework for accounting and thus double entry accounting, there are several types of common accounts that fall into each of these categories. Assets are defined at their most basic level as the resources of a business. So anything you think of as an asset should be understood to be a resource. Common types of asset accounts include cash, accounts receivable, notes receivable, inventory, prepaid accounts such as prepaid insurance and associated accounts, supplies, investment in land, equipment, buildings, land, and patent. All of those are patents and other intangible assets. All of those are common examples of different types of asset accounts. Now, as you think about those, you'll likely notice that that's a pretty wide range. Some of these are short-term assets or ones that we don't expect to take very long to convert to cash. Those are what we refer to as current assets. Common examples of current assets include cash, accounts receivable, notes receivable, inventory, prepaid accounts, and the like. Other types of assets are longer term in terms of their life and their horizon. Accounts such as equipment, buildings, land, and then intangible assets such as patents, trademarks, and copyrights tend to have a longer term horizon. We expect those assets to generate revenues for our business for hopefully several years to come, and so those are referred to as non-current or long-term assets. That same distinction can also be made of liabilities that are short-term in duration, and we define those along practical lines as saying that it's 12 months or less, or the operating cycle of the business, whichever is longer. So if your operating cycle is less than 12 months, the time horizon to distinguish between current and non-current is a 12-month period of time. If your operating cycle is longer, let's say the operating cycle of your business is 14 or 15 months, then that would become the distinguishing time horizon between current and non-current as a general rule. And that applies across accounting fields. So for both managerial accounting and financial accounting, the distinguishing mark between current and non-current is going to be 1 year or the operating cycle of the business, whichever is longer. To digress to liability accounts, these can be thought of in essence as the debts that a business owes. So assets are resources, liabilities are debts. Common examples of liability accounts include accounts payable, short-term notes payable, unearned revenue, accrued liabilities, and long-term notes payable. And similar to the assets category, those liability accounts represent liabilities that are both current and non-current in terms of their time horizon. And then finally, we come to equity accounts. Equity accounts constitute what's often called the residual ownership in the business, the difference between assets and liabilities, which are debts that are owed in order to secure those assets, is the owner's interest in the business. Now, if we're talking about a corporation, that's going to be shareholders, and so we call it shareholders' equity. If we're talking about a sole proprietorship or a partnership, then we're talking about owners of the business, and we'll use the more generic term owner's equity. In either case, we're dealing with the ownership interest of the business, but when we're talking about a corporation, it's appropriate to call this third element shareholders' equity. Owner's equity or shareholders' equity accounts include common stock accounts in the various classes of stock. If the business has preferred stock or various classes of common stock, that would still fall into this category. Dividends, revenues, and expenses. Now, common stock and dividends we often associate with owner's equity in our mind. That's pretty common. But revenues and expenses, if you're not familiar with accounting, might sound a little odd to include there. The difference between revenues and expenses is net income for the period in question. We understand that from the income statement. At its highest level or its simplest form, the income statement is simply revenues less expenses. So the difference between those two represents net income or net loss for the period, and net income has the impact of increasing shareholders' equity, whereas net loss has the effect of decreasing shareholders' equity. So that becomes a component of the equity element. So again, at its highest level, the accounting equation and its associated accounts are assets equals liabilities plus owner's equity. In order to understand a double entry accounting system and how we deal with individual accounts, we use a T account as a representation. You'll see T accounts referenced throughout your textbook in the course of managerial accounting, and this should be something that's familiar to you, particularly if you have a business background, but even if you do, you may benefit from a refresher on this, or if you're not familiar with it, this may be the first time you have seen this in the depth that we're dealing with it on. But a T account represents a ledger account and is used to show the effects of one or more transactions on a given account. We call it a T account because it is in the shape and form of the letter T. You have the account title that goes across the top of the T account. You can see that on the screen before you. And then on the bottom side of the T account, beneath the title, you have two columns. You have a left-hand column and a right-hand column. The left-hand column is what we refer to in accounting as the debit side. The right-hand side is what we refer to as a credit side. So when we talk about debits and credits, that's referring to the nature of how that entry is going to affect a particular account. So if we are debiting the account, then that entry is going to have an effect on the debit side. If we're crediting an account, likewise, it's going to affect the credit side of the account. Always remember, debit's on the left, credit's on the right. It's one of the foundational concepts to understanding double entry accounting systems. Now, let's talk a little bit about the rules of debit and credit. Since we've identified what debits and credits are, we need to understand how and when it is appropriate to post a debit or credit entry to a given account. Using the accounting equation as our guide here, again, assets equal liabilities plus owner's equity or shareholders' equity, we can understand the rules of debit and credit along the following lines. For asset accounts, we debit these accounts to increase them and credit them to decrease. If you imagine that the accounting, or rather the T account that's represented in the accounting equation, imagine that the center line that forms the T runs where the equal sign is in the equation. So the center line for the T account runs between assets on the one side and liabilities and owner's equity on the other. Asset accounts fall on the debit side, and thus it is a debit entry, or it takes a debit entry to increase asset accounts. In similar fashion, for liabilities and equity accounts, these accounts fall on the credit side, and so on a general basis, a credit will increase these types of accounts. And you see that represented at a high level on the screen before you. For assets, we debit these accounts to increase them and credit them to decrease them. For liabilities, we debit them to decrease and credit them to increase. And likewise, as a general rule for equity accounts, we credit these accounts to increase them and debit them to decrease. Now, I will tell you, I'm going to show you a simpler way to summarize all of this information and the various impacts of it here in a couple of slides, but I'm taking you through the foundational principles that lead up to that. So again, depending on where the account falls in terms of the accounting equation, that's going to dictate whether or not a debit or credit will increase or decrease that account. Now, it would be nice if we could just leave it this simple, but as you may be expecting, shareholders' equity complicates things a little bit for us, because shareholders' equity includes accounts that both have the effect of increasing equity, such as common stock and revenues, and it also includes the effect of accounts that decrease equity, such as dividends, which is a return of earnings to shareholders, and expense accounts decrease the equity in the business. Again, if you're thinking back to net income or net loss, you may be thinking, Professor, you said net income increases or decreases equity. Net loss decreases it, net income increases it. And that is true, but bear in mind, net income or net loss is the mathematical difference between revenues and expenses. So if we're thinking in terms of different types of revenue and expense accounts, revenue accounts increase equity, expense accounts decrease it. So this slide breaks out that representation. This is the exact same information that was on the previous slide. The only difference is in the equity section. So if you look at the bottom right-hand side, you'll notice that for shareholders or owners' equity, we've expanded this out a little bit. For common stock and revenue accounts, again, these accounts have the effect of increasing equity. So you'll notice that for those accounts, we credit, because again, equity is on the credit side of this imaginary T account that forms the accounting equation. We credit common stock and we credit revenues to increase their balances. Dividends and expense accounts have the effect of decreasing equity, so they work the opposite way. We debit dividends and we debit expense accounts to increase their balance, and we credit those accounts to decrease them. By the way, whichever side of the T account is going to increase an account. So for example, if we're dealing with common stock, if we credit common stock to increase its balance, whatever that is, the opposite will decrease it. So if a credit increases the balance of the account, then we debit it to decrease it. Likewise, if a debit increases the balance of the account, such as asset accounts, then we would credit it, or do the opposite to decrease it. So whichever side is increasing it, the opposite will decrease it. But again, here you see the equity section broken out with its components: common stock, dividends, revenues, and expenses, and the associated rules. Now, hopefully this is making sense to you so far, but if you're feeling yourself getting a little overwhelmed by the rules of debit and credit, and that's not uncommon, so don't feel bad about yourself if you are having trouble wrapping your mind around this. This is a rather complex set of rules, particularly when you're either A, first learning it, or B, you've not used it in a while and you may not be familiar with it. So just first of all, be patient with yourself, and secondly, here's a graphical representation I show to my Principles of Accounting students that provides a summary of these rules. You'll notice that I've put this in T account format. Again, you've got what would ordinarily be the account title across the top, and then you've got a center line that divides it, forming that T, if you look at the bold divider that's in the center. This is a handy guide to debit and credit rules, and my undergraduate accounting students like to call this ADECLR. You can call it ADECLR or ADECLR, however you want to say it, but that acronym is representative of the elements that each letter stands for. So you'll notice that on the debit side of the T account, we have three different types of accounts: A for assets, D for dividends, and E for expenses, the ADE or the ADDE. Any type of account that falls on the debit side of this representation will be increased by a debit, and thus it'll be decreased by the opposite, which is a credit. So if it's on the debit side, a debit is going to increase it. So assets, dividends, or drawing if we're dealing with a share or a sole proprietorship. And for expenses, we debit expenses to increase them. So we debit assets, we debit dividends, and we debit expense accounts to increase their balances. Likewise, on the credit side, you'll see the CLR, or the CLEAR part of the acronym. The C on that side stands for common stock or the owner's capital account if it's a sole proprietorship. The L is, of course, liabilities, and the R is revenues. If it is an account that falls on the credit side of this representation of the T account, then a credit will increase its balance, and of course the opposite, a debit, would decrease it. So for common stock, liabilities, and revenue accounts, credits increase their balance. So if it's in ADDE, ADE, it's increased by a debit. If it's in CLEAR, CLR, it's increased by a credit. What I suggest, if you're working through journal entries either in practice, if you're doing some analysis, particularly if you don't have an accounting background or you're not dealing with these commonly, and you want a handy guide to help you understand or be able to interpret journal entries, I always recommend to my undergraduate students as well as my graduate students, make a note of this. Put this on a piece of paper that you can keep it somewhere handy, or do a screenshot of this and keep it on your iPad or your iPhone or your computer, somewhere where you can reference it easily. This is the handiest way to be able to represent and remember the rules of debit and credit. Again, if it's an account that's on the debit side of this T account representation, a debit increases it. If it's on the credit side, a credit increases it. And always remember, whatever you do to increase it, the opposite side is going to decrease it. So if you debit it to increase it, a credit will decrease it. If you credit it to increase it, a debit will decrease it. It's just whatever the opposite side of that is. So that's a handier guide, at least more than likely for you, that's a handier guide than the more formalized system of rules that I've shown you in the previous slides. But this way you get both the background information in terms of the application of the accounting equation, and then you get the practical reference that you can use for understanding, analyzing, and interpreting journal entries. Now let's look at a couple of example journal entries in journal format. So journal entries are typically posted along this line rather than in the ledger format we've seen previously. Accounting systems use both, and particularly if you're an accountant or you have an accounting and finance background, you're familiar with the accounting cycle, which involves us doing the analysis, creating the journal entry, posting the entry, then posting the journal entry to the general ledger, and then summarizing all the general ledger accounts at the end of the period to facilitate the adjusting and closing processes, and finally produce, prior to the closing process, producing financial statements and then closing the books. For our purposes in managerial accounting, we're not going to get into that much detail. Naturally, I want you to understand the background of the accounting cycle, but more so what we're doing in managerial accounting, particularly in the context of manufacturing and service companies and looking at information for management, is learning how this type of information, how this data impacts the information that we work with and the relationships that exist between these accounts and these different types of journal entries. But to give you some illustrations of some common journal entries on the screen before you, few points and a few different types of information from a general journal that you need to be familiar with. First of all, the date column, which is always on the left-hand side. That seems like an afterthought, and I realize that, but the date column is of critical importance. We not only need to know what accounts are being affected and the related dollar amounts, as well as whether they're debit or credit amounts, we need to know the date. When did this transaction take place? That is critically important information, and the general journal facilitates record of that information. Then, looking at this first journal entry, you'll notice that we have two line items. We have a debit entry to cash, and then we have a credit entry to common stock. This represents the purchase of common stock by an investor, and thus the investment in a corporation by ownership or owners and ownership interest. So when we have the sale of common stock from a corporation to the public, or if it's a private corporation, to a private shareholder, we will recognize the receipt of cash because we're receiving that cash. And since we're being paid cash, we need to increase that asset account, and we will do that by a debit per our rules of debit and credit we've looked at. Likewise, since we are issuing common stock, we need to increase the balance on that account. Common stock falls on the credit or the CLR side, so we will increase its balance with a credit. So this entry will debit cash for $30,000 and credit common stock for $30,000. You'll see the entries posted appropriately in the debit and credit columns on the right-hand side in the general ledger. One other thing to note is the listing of the accounts in journal format. You'll notice that the credit accounts are tabbed over or shifted over a little bit, what's technically called an indentation in the journal entry form. That is not a strict matter of orthodoxy, but we tab over or we indent the credit entries for a given journal entry in order to help clarify that that is a credit line item. It's just a good visual reminder and representation of the fact that that entry is going to be a credit entry. You'll also notice that the debits are listed first. That is always the case. Debits are listed first, followed by credits. That's just a matter of organization. For accountants like myself who are OCD, that might be a matter of orthodoxy for you, but in terms of the correctness of the accounting system, as long as the entries and their associated dollar amounts are posted in the correct columns, that's the main thing. The presentation here is just for ease of reference and understanding, so bear that in mind. The other thing that I would note, a couple of other things I would note and make clear. Number one, every journal entry must have at least 2 lines. In double entry accounting, double implies 2. As a matter of fact, that means at least 2. A journal entry can have 3 lines, 4 lines, or many, many lines. For example, if you're particularly an accountant who has worked in a corporate entity where you've been associated with payroll processing, you will be aware that payroll entries typically span many, many lines, in some cases hundreds or even thousands of lines, depending on the detail of the accounting system and the nature of the company. When I worked in practice as an accountant prior to moving into academia, I worked with payroll entries that sometimes spanned hundreds of lines. So a journal entry can encompass many lines, or it can be as simple as this example where we have just a 2-line journal entry. But journal entries always have 2 lines, and that also tells us they always affect at least 2 different accounts. You cannot have a single account journal entry in a double entry accounting system. It will always have at least 2 accounts that are affected, and thus 2 lines to the journal entry. The second point is to recognize that the debit and credit columns must always balance. Now, that doesn't mean that you always have to have a corresponding given credit amount that matches the debit amount. For example, if we were to move into a different journal entry, I'll illustrate this with our second example of supplies and cash in a moment, but we might have a situation where we have a $30,000 debit, and then we have one account that's credited for $25,000 and a second account that's credited for $5,000. In total, the debit and the credit columns are still going to balance. They both have $30,000 of entries at that point. That's the rule. So it doesn't have to be a perfect 30 and 30. It can be a 30, a 25, and a 5, but the fact is the debits and credits must always equal. Now let's move to our second example entry, and that is taking place on December the 2nd, 2019 in this example, and on this day we purchased supplies for cash. So in this case, we are debiting supplies, which is an asset account, a resource of the business. We increase its balance by debiting supplies for $2,500, the amount of supplies being acquired in this example. And then, in this case, we would credit the form of payment. Since we're paying cash, we need to reduce the cash account. If you hand somebody $2,500 for supplies, you no longer have that $2,500 in your possession, or as some might say, you're $2,500 poorer than you were. At least in terms of cash, you still have $2,500 of supplies you've acquired, but you no longer have that same dollar amount in cash. You sacrifice that in order to acquire the supplies, so we need to reduce the balance in the cash account. And we will do that by crediting cash. Cash is also an asset, so a debit will decrease its balance. A credit then will decrease its balance. A debit will increase it, a credit will decrease it, and so we will credit the cash account for $2,500. This entry would appropriately record the purchase of supplies for cash. Now let's modify our assumption just a little bit here. Let's assume that we bought supplies and we decided to pay on account, meaning that we acquired supplies today and made an agreement with the vendor from whom we're acquiring the supplies to pay for those supplies at some point in the future, say 30 days or 45 days in the future. If that's the case, we have a liability, a debt that we now owe to that vendor. We would typically recognize that by recording an entry, a credit entry to accounts payable. So we would still debit supplies for the amount acquired, in this case $2,500, But if we were paying for it on account, instead of crediting cash at that point, we would credit accounts payable for $2,500, increasing the balance in that liability, and then we would remove it and reduce cash at the later point when we actually pay for that and pay the bill. But this is a basic illustration of what we would typically see with journal entries, both a couple of common examples of common journal entries, and more importantly, the format you can expect to see journal entries in. So with that concludes our refresher on double entry accounting and journalizing transactions. Thanks for watching. If you have any questions or need some clarification on any of these items, please do not hesitate to reach out. You can contact me at the email address or the phone number provided in your course syllabus in the professor's contact information tab. But again, thanks for watching and have a fantastic day.